Ever heard the saying, "Don't put all your eggs in one basket"? What if I told you that by the end of this video, you'll have a step-by-step guide on creating a diversified investment portfolio that can protect your wealth and secure your financial future? Stay tuned and let's unlock the secrets to smart investing. But before we dive in, remember to smash that subscribe button and hit the notification bell to stay updated on all our latest content. Did you know that during the 2008 financial crisis, people with diversified portfolios were able to minimize their losses and recover more quickly? If you want to learn the art of safeguarding your investments, then you've come to the right place. So, what exactly is a diversified investment portfolio? Simply put, it's a collection of different types of investments that work together to minimize risks and maximize returns. Think of it as a financial safety net that prevents you from losing everything if a single investment goes south. Now that you know what a diversified investment portfolio is, let's talk about its benefits. Firstly, by spreading your money across different types of investments, you can minimize the impact of a single underperforming asset, thus reducing the risk involved. Next, diversification will provide you smoother returns as it helps to balance out the ups and downs of the market, leading to more consistent returns. Finally, having a diverse portfolio allows you to capitalize on various market trends and investment opportunities. Sounds good, right? Let's dive into how you can build your own diversified investment portfolio. Building a diversified investment portfolio is like assembling a winning team. You need to have the right mix of players with different skills and strengths. So let's explore the key players you should consider in your investment lineup. Number 1. Stocks. These are shares of ownership in a company. Stocks can offer high returns, but they also come with higher risks. To diversify, invest in different industries, company sizes, and geographic locations. Number 2. Bonds. These are loans you give to companies or governments in exchange for interest payments. Bonds are generally less risky than stocks but provide lower returns. Diversify your bond investments by considering various issuers, maturities, and credit ratings. Number 3. Real estate. Investing in properties can provide both rental income and potential appreciation. To diversify, consider different types of properties, locations, and real estate investment trusts. Number 4. Cash and cash equivalents. These are short-term, low-risk investments like savings accounts, money market funds, and short-term government bonds. They provide stability and liquidity to your portfolio. Number 5. Alternative investments. These include investments like commodities, private equity, and hedge funds. While they can add diversification, they also come with unique risks and may not be suitable for all investors. Now that you know the key players, here are some tips to help you build your winning investment team. Firstly, assess your risk tolerance. Before investing, determine how comfortable you are with the ups and downs of the market. This will help you decide on the right mix of assets for your portfolio. Secondly, diversify within asset classes. Don't just invest in one stock or bond. Diversify within each asset class to spread the risk even further. Thirdly, rebalance regularly. Over time, your portfolio's asset allocation may change due to market fluctuations. Periodically rebalance your portfolio to maintain your desired level of diversification and risk. Fourthly, use low-cost, diversified investment vehicles. To simplify the diversification process, consider using low-cost index funds or ETFs that represent a broad range of assets. Lastly, stay disciplined and patient. Building a diversified investment portfolio is a long-term strategy. Stick to your plan and avoid the temptation to chase after hot investments or time the market. Before we wrap up, let's discuss some common mistakes people make when trying to diversify their portfolios. While diversification is essential, having too many investments can make it difficult to manage your portfolio effectively. Also, focusing only on diversifying across asset classes can leave you exposed to risks within each category. Always consider the impact of fees and taxes on your investments, as they can significantly affect your returns. Not forgetting that emotional investing can lead to poor choices, like selling low or buying high. Stay disciplined and stick to your long-term plan. And there you have it. With these tips and strategies, you're well on your way to building a diversified investment portfolio that can secure your financial future. Remember, diversification is your financial safety net. It's like having a superhero squad protecting your wealth. Thank you for watching. If you found this video helpful, please give it a thumbs up and don't forget to subscribe for more valuable content. Have any questions or suggestions? Leave a comment down below, and we'll see you in the next video.